The financial condition of the U.S. Is very poor. The debt to GDP ratio is at a very high level, and at such a high level that it is actually pressing down on the ability of the economy to expand. When that happens, as we have seen in many cases before, you tend to get pressure on the purchasing power of the currency, i.e., what we call inflation. Now, it's a different kind of inflation. It's not demand pull or cost push, but it's a different kind of inflation. It's basically a balance sheet kind of inflation, and that isn't going to go away. And in fact, we'll have to see what Donald Trump is going to actually do, because if he cuts taxes, well, that's not going to help anything. If he just continues on spending, and I think one of your guests just on here were pointing out that where are they going to cut? Not Social Security, not Medicare, Medicaid, all that kind of stuff. So where are they going to cut? Who knows? And Donald Trump isn't the kind of guy who likes to cut anyway. So I think we're going to see more and more pressure from increasing debt levels, and that has only one effect at this point, and that is to say it will tend to push down the purchasing power of the dollar. In other words, inflation comes.
Right.
And by the way, and I think that's why the Fed has been very cautious in cutting.
Right. Why do you say cutting taxes will not do anything? Wouldn't that help corporations? Wouldn't that help the economy, GDP? No?
Mark, if that were the case, then after all of the tax cutting and so on that has gone on, the U.S. economy, by the way, by my calculations, would be probably 25 to 30% higher than it is. It's not only cutting taxes, but it's having a solvent balance sheet, which encourages expansion. And what do we hear from business leaders everywhere? They're really concerned about those debt levels,
right.
And so they should be.